JPMorgan Chase Chief Economist Anthony Chan is with us right now. Anthony, the Federal Reserve just has to maintain stability. That's its desired goal. It doesn't want inflation to get out of hand. So it has a very tight rope to walk. And rarely does it succeed. I mean, it could either overdo it or it can underdo it. What is your sense of where the Fed stands now?
Well, monetary policy is always a blunt instrument, and that's the reason why they err sometimes on the side of causing a recession, unintentionally, of course. But right now, the Federal Reserve, I think, is doing pretty good because they're not raising rates at the normal pace that they usually raise rates. They're raising rates at a fraction of the pace that they're historically
It's enough of a fraction to tick off the president.
Well, that's a political situation. But in terms of the economics, the Federal Reserve seems to be doing less rather than more. And today's employment report, not only was it a good one, but it suggests that the economy is still going. Now, keep in mind, though, Neil, that when you look at employment is a coincident indicator. And when you look at some of the leading economic indicators, which today nobody wants to talk about, like the ISM manufacturing index that actually got a lot softer, it does suggest things could get a little bit softer later on. And that's one of the reasons I was very impressed with the Federal Reserve today, saying that they're really going to be more data dependent. That's exactly what you want from a central bank. And in fact, if they see some of these leading economic indicators getting weaker because changes in policy impact the economy a year and a half later, they will adjust policy. That's exactly what you want.
I've asked a lot of very smart folks, and I certainly include you in that bunch, Anthony, about the president and his relationship with Jerome Powell. It has been acrimonious, to put it mildly. Jerome Powell said that even if the president were to ask him to resign, he wouldn't. Do you think it would ever come to that?
I think that at this juncture, the economy is doing very well. There's certainly a lot of discussion on both sides, but I don't think they're anywhere near a situation like that. And by the way, if they did get to that point, today we got that answer. Jerome Powell said he simply wouldn't resign. So that's off the table.
You're damned if you do, damned if you don't, if you're the Federal Reserve Chairman, right? If you don't raise rates, it's because you're intimidated by the president. If you do, you're spiting the president. He can't win.
Well, I think he could win because today he made it very clear that he's only going to change rates. They're going to be patient if the economy gets stronger. I think that he basically hit the financial markets with a 2x4 to try to convince everyone out there that the Federal Reserve will only move if it's justified. And we know that in 2019, I don't see any signals that we're likely to go into a recession. There are some things out there that are lingering that would suggest that there is risk of a recession in 2020. But for 2019, I think an expansion is
overdue for one at this point, right?
Well, but again, recessions or expansions don't die of old age, as Ben Bernanke has reminded us. And in fact, history shows it, that economic expansions die of some sort of a catalyst. And so the catalysts that are sort of brooming in the horizons or in the shadows is something that could probably hit us in 2020, but not in 2019. And in fact, one of the things I was very impressed with, that many people were looking for weakness in the cyclical sectors like manufacturing and construction. And both of those sectors, unemployment today came in pretty high.
Yeah, I was very shocked by that. In construction up 38,000. Manufacturing up 32,000. Retail up 24,000. In the decades we've known each other and talked, I mean, I always feel that whatever downdraft comes in a market, it's because of a bubble that was building that most people didn't see coming until it was too late. You could talk about real estate. You could talk about, some say today, what happened in the bond market since. Are there bubbles that you watch? Are there problems or people returning to old ways that worry you? What?
I really don't see a lot of bubbles in the equity market. The Federal Reserve puts out a weekly index on financial conditions, and that actually has been getting tighter and tighter and tighter, so less likely of a bubble
but I still see
equity
these
markets.
5 to 7, 8-year car loans going on right now. Not exactly no doc, adjustable rate mortgages, but fewer doc, adjustable rate mortgages.
These are all things that we're watching. And by the way, Neil, they are a much smaller share of the total pie than they were back in 2008 and 2009. But if you really want a catalyst, I'll give you one. If you look at corporate non-financial debt as a percentage of GDP, it is lingering higher. And by the way, that's one of the reasons why when you look at high-yield debt spreads, they've blown out. Certainly over the last couple of weeks.
And they've blown out particularly among those who might be least prepared to pay back the money.
Well, you've seen energy prices coming down, and of course, we know that we have between 15 and 20% of the high-yield market basically accounted for by energy. So if energy prices are down, that certainly has an impact. To the extent that we see the economy improving a little bit, some of that will go away. And in fact, we've seen a little bit of a bounce back in energy prices. So these are all things that we're watching. But there are certainly some things out there that tell us 2020 is a danger.
Did you find it odd during the holiday period where Treasury Secretary Mnuchin was trying to reassure the banks that there was adequate capital to protect them, that just in case? That scared a lot of people at the time. I know his intentions were good, but did it tip his hand that the administration's worried about this more than it lets on?
Well, that's the way the financial markets interpreted it, but I actually viewed it as a very transparent move on the part of the Treasury Secretary. It's basically telling people we're minding the store, we're watching everything, we're making sure that we don't wait until it's too late. So I actually applaud the search for things that could be a little bit of a problem. But again, I know some people have interpreted it. If you're looking for a problem,
right,
you must think there is a problem. But at this
so you're
point,
optimistic right now?
Over the near term. But I think some sort of a mild, not a global financial crisis, but a mild recession in 2020, I think is certainly a strong possibility.
All right, you just have to hurry up and start aging because I can't do this alone.
Okay.
All right. Anthony Chan, we've talked for decades now, JPMorgan Chase Chief Economist, a very, very good read of the economy and the markets. That's tough to do, to get them both right.